2025 and 2026 are shaping up to be defining years for the global economy. Inflation may be cooling on official reports, yet for most people, everyday living costs remain stubbornly high. Debt levels are exploding across developed and developing nations alike. Political tensions are rising. Global trade is being reshaped. And underneath all of this, gold and silver are quietly positioning themselves for a move that most people, including many analysts, are simply not prepared for. In this video, I want to talk through the deeper forces that will shape the next 18 to 24 months. Not the headlines, not the short-term noise, but the underlying drivers that will influence currencies, markets, and precious metals. Let's begin by setting the scene. Although central banks would like us to believe that inflation is under control, the reality is far more complicated. Prices may no longer be rising at the same speed as last year, but they remain significantly higher than before. Food, fuel, energy, rent, insurance, these increases are not reversing. People are still spending more and getting less, and wage growth is not consistently keeping pace. At the same time, though interest rates are currently falling, they are well above the average for the past 10 years. For households, this means higher mortgage costs and tighter spending. For businesses, it means higher borrowing costs and slowed investment. For governments, it means something far more dangerous. The cost of servicing national debt has jumped dramatically. This brings us to the first major hidden force influencing 25 and 26 and beyond: the global debt rollover crisis. Most governments borrowed heavily during the era of near zero interest rates. Those cheap debts are now expiring and must be refinanced at much higher rates. This is not a small issue. It affects the United States, the United Kingdom, Europe, Japan, Canada, almost every advanced economy. When countries roll over trillions of dollars of debt at dramatically higher interest rates, three things happen. First, deficits balloon even further. Second, governments must borrow even more to cover those deficits. And third, confidence in national currencies begin to erode. The exact pattern has historically supported rising gold prices. When trust in fiat currencies weaken, gold becomes more attractive as a store of value, not a speculative asset, but a form of financial insurance. Silver, although more volatile, often follows. The second hidden force shaping 25-26 is political. Whatever one's political view, there's no denying that the Trump administration has created significant economic and geopolitical debate. Tariffs have pushed prices higher in some sectors, markets remain volatile, and immigration reforms continue to reshape labor dynamics. With the midterms approaching and opinion polls tightening, investors are increasingly questioning what comes next. But this is not just about the United States. Europe is still navigating energy uncertainty. China is managing a slow-moving property crisis. Emerging markets are facing currency instability, and geopolitical risks from Eastern Europe to the Middle East to the Pacific remain elevated. And these political uncertainties directly influence investor behavior, particularly in the precious metals market. Periods of political tension have historically been supportive for precious metals. When people become unsure about the world, they look for assets that don't rely on government promises. This is why both gold and silver have breached all-time highs, and silver has broken above $50 for the first time since 2011, a level many serious analysts believed would take much longer to revisit. The third hidden force shaping the next 2 years is one that will still surprise many viewers: record levels of central bank gold buying. Over the past few years, central banks purchased more gold than in any comparable period of modern history. The biggest buyers are countries that are attempting to reduce their reliance on the US dollar in international trade, including China, Russia, India, Turkey, and others. This behaviour is not temporary. It's a long-term shift. Central banks do not buy gold for speculation. They buy it for stability, for diversification, and for political leverage. And when central banks keep buying, they create a strong underlying demand that supports gold during downturns and accelerates gains during upswings. Now that we have covered the major forces, let's examine what they mean for gold and silver prices in the coming years. For gold, the medium-term outlook is positive or constructive. Falling real interest rates, whether through slower inflation or eventual rate cuts, tend to benefit gold. Debt refinancing pressures weaken currency confidence, which benefits gold. And geopolitical instability almost always boosts safe haven demand. Based on current trajectories, gold moving into the mid 4,500 range in 2026 is realistic. If central bank buying continues at anything close to current levels, and if political or economic shocks occur, we could see moves towards $5,000 before the end of 2026. Silver, on the other hand, remains more complicated, but it is also the metal with greater upside potential. Industrial demand for silver continues to rise, particularly from the solar industry, electric vehicles, electronics, and defense technologies. Silver benefits from both safe haven demand and industrial growth. This dual nature makes it volatile, but also means that when it moves, it can move very quickly. If gold breaks even higher, silver typically follows with more force. A rise to $60 in 2026 is easily achievable, and the mid to upper 60s or even low 70s become possible if industrial demand accelerates or if economic uncertainty boosts investor interest. However, there are risks. A deeper global slowdown could temporarily reduce industrial demand for silver. A sharp disinflation could pause gold's momentum, and unexpected central bank policy shifts could strengthen major currencies in the short term. But looking at the broader picture, the combination of rising debt, political uncertainty, and structural central bank demand creates a long-term environment where gold and silver are positioned to perform strongly. The next 2 or 3 years will be shaped by forces that most people will not fully see or understand until they are well underway. In fact, they already are. Debt pressures that can no longer be ignored, political and economic cycles that are increasingly difficult to predict, and subtle but powerful shifts in the global monetary system. Now, gold and silver are not cure-alls, but in uncertain times, they remain assets that have protected wealth for thousands of years, and they may play a particularly important role in the period ahead. Now, if you found this video helpful and would like more calm, clear, and practical insights into precious metals, the global economy, and the forces shaping our financial future, feel free to subscribe. Also, press the bell sign, because there is more, much more content coming, and I look forward to sharing it with you. Thank you for listening.